Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Planet Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For many years, this company was, viewed as a high-growth, cash-burning space asset, but the narrative has clearly shifted.
It really has.
We're looking at a fundamental inflection point toward profitable growth.
Okay, so this recent quarter wasn't just good. It really showed genuine acceleration. What were the key revenue takeaways that, signaled this big shift?
Right. The figures really do speak for themselves. They delivered a record Q3 for a fiscal year 2026 revenue of $81.3 million.
$81.3 million.
And crucially, that's a 33% jump year over year, which significantly beat what the market was expecting.
So that beat immediately translated into more confidence going forward.
It did. They raised their full-year FY26 revenue guidance to the midpoint of $299 million.
Oh.
So it's not just growth, it's an increasing pace of growth.
The top line is great, but what gives investors confidence that this momentum is, locked in for the long term?
That's where you have to look deeper at the customer commitments. It really changes everything. We need to look at two key metrics here: backlog and remaining performance obligations, or RPOs.
Okay.
The total backlog has surged an immense 216% year over year. It's now at $734 million.
A triple-digit jump in backlog is massive, but maybe for our listeners, can you explain why RPO is the metric that really matters for that long-term confidence?
Of course. Think of RPOs as legally binding revenue that they haven't earned yet. It's tied to multi-year contracts, especially with government and big enterprise clients.
So it's not speculative, it's committed money.
Exactly. And this quarter, RPOs rose an astonishing 361% to $672 million.
Wow, 361%.
Yeah. I mean, backlog can sometimes be a bit squishy, but RPOs are the hard commitments. They provide that clear, multi-year revenue visibility.
And how does that break down over the next few years?
Roughly 60% of that, of the $672 million, is expected to convert into revenue over just the next 24 months. For a company once seen as speculative, that provides, serious structural de-risking.
And that de-risking leads us right into the most critical part of the story, right? The transition from growth at all costs to, self-funded growth.
It truly is. The old narrative that it was this infrastructure project constantly needing new capital, that's just been tossed out the window. The company it has fundamentally flipped the switch.
Okay, so what's the proof? Point out the key profitability metric that really shows this transition.
The one to watch is adjusted EBITDA. They delivered a Q3 FY26 adjusted EBITDA profit of $5.6 million.
And that's not a one-off, is it?
Not at all. This marks the fourth consecutive quarter of adjusted EBITDA profitability. They are reliably covering their operating expenses now.
But is this just, an adjusted profit that looks good on paper, or are they generating real cash? What about free cash flow?
They are, and that's the ultimate proof point for a business like this. Q3 FY26 was the third consecutive quarter of positive free cash flow, hitting about $0.9 million.
So they're on track for a full profitable year then?
Absolutely. They're on track for their first ever full-year adjusted EBITDA profit, guided between $6 and $8 million, and full-year positive FCF for fiscal 26.
So they're proving their massive space operations, all the launches and satellite replacements can now be funded internally.
That's the core takeaway. Now we can look at their huge balance sheet as pure strategic funding for growth, not just runway for survival.
That's a huge distinction. How much strategic runway do they have to invest in the new Pelican and Owl constellations?
They're sitting on a massive cash fortress. The company has a really strong balance sheet, with $677 million in cash and equivalents.
Wow.
And on top of that, they recently raised another $460 million through a convertible note at an ultra-low 0.5% coupon rate.
So when you stack that cash against the low debt costs, they basically have no net leverage.
Precisely. Which means instead of worrying about debt servicing, they are free to accelerate development.
Right.
That's a huge competitive advantage.
Let's talk about that advantage, that moat. If this business is so profitable now, why can't a competitor just launch a few satellites and catch up? What makes their data unique?
That's the key question, and the answer is multi-layered. First, it's just scale and frequency. They operate the largest commercial Earth observation fleet out there.
The super doves, the skysats.
Exactly. And that scale allows for near-daily global coverage. A competitor can't just take a picture when you ask. This is a systematic, living historical archive being built every single day.
And you can't replicate that historical context overnight.
It's the absolute foundation of their advantage. That unique data set creates extremely high switching costs for customers. If you're building an AI model to track, say, climate change or military buildups over the last 5 years, that model is trained on their proprietary images.
So you're locked in. You can't just switch vendors.
You'd have to retrain everything from scratch. So the real moat isn't the steel in orbit, it's the data on the servers. And they're making that moat deeper
How so?
with new hardware. The Pelican 5 and Pelican 6 launches offer sharp 40-centimeter class resolution and, crucially, they integrate NVIDIA Jetson AI hardware right on the satellite.
So they're doing edge computing in space.
That's it, a huge efficiency gain. And the upcoming Owl constellation is designed for near-daily 1-meter imagery of the entire global landmass. It's all about enhancing intelligence gathering.
This all suggests the business is moving beyond just selling raw imagery, right? It's about that high-margin software layer.
That's the pivot from an asset play to a platform play. The acquisition of Bedrock Research, the Edge AI, it transforms them into a true geospatial intelligence platform.
So they're selling the answer, not just the data.
Exactly. Higher margin analytics, anomaly detection, and this edge is translating into critical government contracts.
Right, like the NGA Luno B contract.
Precisely. That's a major validation. And a $7.5 million U.S. Navy renewal for vessel detection, plus ongoing renewals with the NRO and NATO, they're embedding themselves deeper and deeper.
And I guess if we connect all these dots, the RPO, the cash flow, the moat, the market has, well, clearly taken notice.
Notice is an understatement. The stock has seen absolutely explosive action. We're talking gains between 384% and 654% over the last 12 months.
And there was that big jump right after the Q3 earnings, wasn't there?
A huge jump, around 36% in a single session.
With a run like that, a lot of investors are probably wondering if the gains are stable or if it's all just speculative.
Well, the technical context suggests it's structural. This feels like a genuine accumulation phase, a confirmed uptrend. What's most important is that prior resistance levels in the mid-teens are now acting as key support.
Which indicates a major breakout.
A major breakout from a multi-year base. This isn't just retail frenzy. This signals that institutions have accepted the new financial reality of the business.
Okay, that said, with a massive run-up like that, we have to talk about the risks. Let's start with the one that gives people pause. Leadership selling.
Yes, there was notable insider selling. The CEO, Will Marshall, sold about 200,000 shares, around $3.1 million worth.
And the CTO as well, right?
Right, the CTO sold about 81,000 shares, which is around $1.27 million. That was back in October.
And that's significant money. For a cautious investor, seeing the C-suite sell can be a red flag, no matter what the story is.
It can be.
Yeah.
But you have to contextualize it. These sales followed an extraordinary multi-100% rally.
Mm-hmm.
For executives who've been there a long time, this is often seen as, typical diversification.
Just taking some profits off the table.
Exactly. It doesn't necessarily signal a fundamental problem, especially since analyst sentiment remains net positive.
Okay, let's move to financial risks. You mentioned they're profitable on an adjusted basis, but what about the GAAP numbers?
That's the main financial risk, the contrast between the two. While they hit adjusted EBITDA profit, the company still reports GAAP net losses. The Q3 GAAP loss was $59.2 million.
So why does the market ignore a $59 million GAAP loss, but cheer a $5.6 million adjusted profit?
Because for a growing infrastructure company, those GAAP losses are largely driven by non-cash charges, like depreciation on that massive satellite network. The market is focusing on free cash flow, which shows they can cover operating costs and fund the next generation internally.
And there was also some concern about margin compression.
Correct. Non-GAAP gross margin compressed slightly, from 54% to 60%. And Q4 guidance actually anticipates a temporary step back in adjusted EBITDA.
A step back. After 4 straight quarters of profit, why would the market tolerate that?
Because it's viewed as a necessary investment, not a structural weakness. The dip is tied to seasonal launch costs and investment in the Pelican and Owl ramp-up. The market is looking at the backlog, the FCF, and seeing this as a tactical move for long-term gain.
Okay, final risk. Concentration. They rely heavily on big government agencies, right? The NGA, NATO.
Absolutely a major risk. If the NGA or NRO were to cut spending, it would be a huge headwind.
But what's the mitigating factor there?
It's that 216% growth in the backlog. It suggests they aren't just maintaining, but gaining market share. They're becoming less of a vendor and more of an indispensable partner, which makes those switching costs for the government extremely high. And looking ahead, say over the next 3 months, there are some really concrete catalysts. The big one will be Q4 earnings and the full year FY27 outlook, which we'll see around March.
And we should expect some technology milestones, too, to validate all this investment.
Definitely. Look for announcements about first light data, the first usable images from Pelican 6 and Owl. Every successful launch validates their roadmap. And finally, just expect continued contract momentum, especially with, everything going on in the world.
It really does seem like the business model has reached escape velocity. It's moved from being a pure satellite play to a high-moat AI-driven data platform.
Exactly. The question for you, the investor, isn't whether they can build the archive or turn profitable anymore. They've done that. The question now is, if their archive becomes the foundational data set for a trillion-dollar AI industry, what's the next step? Do they unlock even higher valuations by separating their AI software services from the hardware business?
Yeah.
That future capability is what truly sets them apart.
A fantastic area to watch. If you found this discussion helpful for understanding Planet Labs, please remember to subscribe so you don't miss our next analysis. We'll talk to you tomorrow.